Well, it looks like the time has arrived, so let's begin. First of all, I want to thank everyone for joining us this afternoon for the second quarter 2020 market update town hall meeting from United Church Funds. My name is Matt Wagner. I serve as the Vice President of Institutional Relationships for our organization. And again, want to welcome everyone and certainly appreciate your time. As a first order of business, I'd like to be able to introduce our President and Chief Executive Officer, Reverend Charles Buck. Charles is going to walk through the first couple of introductory slides about United Church Funds, give you a few organizational updates. Then we'll dig into some performance and market strategy slides. And finally, go through some socially responsible investment slides led by Stacy Pettis, our Executive for Institutional Relationships. So Charles, take it away.
Thanks so much, Matt, and thank you for all of you for joining us. Matt and Stacy and I are very much looking forward to sharing today with you. And I just want to mention that we have a couple of other staff with us, Adam Sank and Debbie Wibowo of our communications team, who are handling the back of house kinds of details. So we appreciate their help in all of this. I want to say that United Church Funds is grateful for entrusting us with the stewardship of your assets. Currently, we're managing over $850 million of investments and endowments that belong to over 1,100 churches and ministries. And as you can imagine from watching the market, that number has fluctuated pretty wildly these last several months. Thanks for hanging in there. After this last quarter, we've pretty much come full circle back up to the levels that we were at the start of the year. I'll leave those kinds of details to Matt Wagner, but I want to mention that our strong and competitive investment performance has long gone hand in hand with our responsible investing mission and focus. Our experience actually supported by empirical research is that we don't have to sacrifice one for the other. And so we incorporate this responsible investing throughout all of our 13 actively managed funds. And Stacy Pettis is going to say some more about our responsible investing later. Could I have the next slide, please? So we fulfill our mission and our trust to you through outstanding and dedicated individuals on our staff. And many of you have interacted with these folks who you see on the screen there. But a name that I want to highlight right now is Matthew Illian. He's our new Director of Responsible Investing. You may have read something about him in our recent client email or from today's UCC News. Matthew actually starts next Monday. That's why he's not with us today. And we look forward to benefiting from his diverse expertise in capital markets, financial planning, and impact investing, as well as his personal passion and commitment for faith-informed responsible investing. You'll get to hear and see Matthew in coming months, including probably at the next town hall meeting. Next slide, please. So all of the staff are really grateful to be supported by an outstanding board of directors and investment committee. All of them here represent the diversity and the expertise that we're so gifted to have in the United Church of Christ. And you can find all of their bios and backgrounds, as well as those of our staff, on our ucfunds.org website. Next slide, please. Although investing with a mission is at the core of what we do, we also support your mission and the mission of the United Church of Christ in other important ways as well. One of the ways that we do that is the Brown Endowment. We administer nearly $400,000 in scholarships and grants annually. And I just want to share that recently we awarded almost 30 scholarships to members in discernment. These are persons preparing for authorized ministry. And these mids are coming from 21 conferences out of a total of 36. They attend 15 different seminaries or regional theological educational programs. And then we also have been providing over $100,000 so far this year in funding to conferences to support their clergy. Our clergy, as probably many of you have seen, are facing unprecedented levels of stress and burnout in this time of prolonged pandemic and in the passionate protest for justice. So thanks to the Brown Endowment, conferences are providing interesting, innovative programs, I think, that offer to their clergy healing, support, and resourcing. And another way that United Church Fund supports you is through our planned giving. We support and administer the UCC's planned giving ministry. And plan giving is a way to help your members with their estate planning, as well as a means to ensure your church's or organization's future mission. You can learn more about this at our ucfunds.org website. Next slide, please. You know, not long ago, there was a corporate CEO who talked about how ESG was going to have to take a back seat. Environmental, social governance factors, things like climate change, human rights, management diversity. He said we would need to put these aside for now, given the state of the economy. And this would allow companies, he said, to focus on the bottom line or strengthening their balance sheets. Well, you know, I think the over $12 trillion sustainable investing world, that includes United Church Funds, would disagree with that. I want to say that now more than ever is when we need to focus on making the changes in our world that sustain life and guarantee equity and justice for all. And so at United Church Funds, our vision is investments that create a just world. And I want to assure you that we are more committed than ever to harnessing the power of investments to making that just world a reality. So I want to thank you for entrusting us again with the stewardship of your assets and joining us in this journey. Matt, I'll turn it back to you.
Charles, thank you so much for that. Greatly appreciate it. Our next step, we're actually going to ask that all the attendees do a quick 2-question poll for us. I'm going to open that up. We have one question on endowment policies for your church or organization, and then another question specific to planned giving. So I'm going to launch that now. We're going to spend about 20 or 30 seconds. I'd ask that you please answer the questions, and then we will roll on to performance and market strategy. Thank you so much, everyone, for participating in the poll. We greatly appreciate it. For some reason you didn't get a chance to participate but would like to, you can feel free to share your answer in the chat, and we'll make sure to include your results along with the rest of the polling. With that said, let's get started with some strategy and positioning and how this quarter has gone. We're going to take a look at a little bit of a recap of Q2, and then also have some slides as it relates to where we are going in Q3 and beyond. Just a couple of quick bullet points here to sort of set the stage for the conversation. As we've seen coming out of April and May and continuing into July, what we've experienced is markets that are diverging from a relatively weakened economy due to COVID-19. Markets continue to expand, particularly equity markets in the US. However, that's in the face of 10% unemployment here in the US and obviously hobbled hospitality industries, travel industries, the restaurant industries, et cetera. Certainly the virus has impacted some industries more than others, but our economy as a whole certainly has been significantly hurt. Markets have been a little bit on a roller coaster ride. If you watch it every day, watch it go up and down. The job at United Church Funds is to be long-term investors, and I can assure you that our investment team, Dave Clausen, Manoti Dhanaraj, and Lon Kai, have done an outstanding job of making shorter-term decisions that are going to impact our portfolio, what we believe, in a positive way on a longer-term basis. At United Church Funds, we always remember that the vast majority of our clients have very, very long time horizons, and it's up to our team to make sure that we're investing for the longer term for the benefits of your mission and ministries. With that said, some dynamic allocations over the short term can certainly impact those longer term allocations. And actually, Dave, Lon, and Manoti and that team actually increased our equities towards the end of Q1 and into the beginning of Q2, which helped us ride sort of the equity wave that we saw through the second quarter, which again was a fantastic quarter overall, and continuing into July. We're certainly keeping an eye on some additional risks, including U.S.-China trade talks, and of course the presidential election, which is looming on November 3rd, 2020, just 99 days from now. When we look at selected index returns, so on the left of this chart, what you'll see are indexes from across the globe, with equity indexes at the top and fixed income indexes towards the bottom, with a couple of alternative asset classes at the very bottom of the page. But you'll see there the ACWI IMI, ACWI stands for All Country World Index, up 20% for the quarter, still down about 7% for the year. but a fantastic turnaround in Q2. Small cap stocks, as defined by the Russell 2000, up over a little bit more than 25% just for the quarter, and the S&P 500 up about 20% as well. So really a very positive quarter for equities as a whole. When you go down the page towards the Barclays and JPM indexes, those are the fixed income indexes, you'll see clearly, for example, Barclays US long treasuries, which led the way in Q1 as we went through all of the downturn and volatility that we saw in March. Obviously significantly underperformed equities as in Q2. And you can see that both for the Barclays Global Aggregate as well as US long treasuries. Of high note in fixed income, with the low interest rate environment and the Federal Reserve's some of the stimulus and some of their other policies, it created sort of a attractive opportunity for risk-on trades in fixed income. So we look at global high yield, emerging market debt, both returning about 12% for the quarter. Those are historically more risky bond asset classes, but performed rather admirably with a higher correlation to equities in Q2. On this side, you'll see as we drill down a little bit deeper into U.S. equities, we can generally define sort of three broad strategies in U.S. equities: small companies, medium-sized companies, and large companies, and then value strategies, growth strategies, and then strategies that blend both value and growth together. And you can see for the quarter in the top right-hand column, strong performance for U.S. equities across small, mid, and large cap. Where you'll see a little bit of a divergence, however, is the outperformance of growth strategies versus value strategies, both for the quarter and also year to date in the top right-hand column, or excuse me, the top right-hand chart. When you look at the two bottom charts, since the market low in the bottom right-hand corner, since the market low, which was March of 2009 of the financial crisis, you can see a significant outperformance of growth versus value. One of the things, the reason that we're showing you this chart is that one of the things that our clients benefit from, particularly in our balanced funds at United Church Funds, is a multi-manager format. So United Church Funds, we have the ability to overweight or underweight growth or value managers in our equity, particularly in our U.S. equity funds. And our investment team over the last 10 years has done an outstanding job in picking the right times to be slightly overweight or slightly underweight various strategies, allowing us to remain invested fully or the vast majority fully at all times, but to be able to pick and choose our times to be invested slightly overweight or underweight in these strategies. And we'll have a slide in just a few moments that'll highlight that in real terms for our funds. Here you can see fixed income returns and yields for as of 6/30/2020. And while returns, of course, for the year for short duration treasuries as well as corporate debt have been muted a little bit in Q2. You can see there right in the middle of that, the charts on the left, the 2020 year-to-date returns and those yields, which are, of course, have contracted significantly since February and March of 2020. Yield on the 10-year at 66 basis points as of 6/30. That's down from 70 basis points on 3/31/20. So even across the quarter, some additional contraction of interest rates. The chart on the right is an interesting one. It shows the gross issuance, January versus May of 2019 versus 2020. And clearly at the top there, you see U.S. Treasuries, significant issuance, some 2.2 trillion in order to help stimulate our economy. And of course, the Fed has done that with the issuance there as well as with the interest rate environment. As the rubber hits the road for our clients, we have two slides. Over the next two slides, we'll show you our net of all fee performance as of 6/30/2020. We're actually very proud to report that 5 of our 7 managed funds exceeded their benchmark for the quarter, and actually 6 of our 7 managed funds exceeded their Lipper benchmark as well. We are starting on this chart. Some of you may have seen this chart before, but without this additional line where you see a line item for Lipper. Lipper is a benchmark or an index that takes actively managed funds and various fund managers and puts them together to create another kind of benchmark. So while we do have the S&P 500 index, for example, or the Russell 2000 index, which are unmanaged and do not charge a fee, we find it beneficial to our clients that you can also see what sort of an average, if you will, active manager has done over the same time frame. And so you'll note that our track record over the course of longer periods of time, and in some cases shorter periods of time, have done quite well versus their benchmarks and that sort of Lipper peer universe. So here are our managed funds. You'll see there domestic core equity, small cap equity, and international equity leading the way for Q2. Our Beyond Fossil Fuels fund also did exceptionally well for the quarter. The vast majority of our clients use one or more of our balanced funds for your fund lineup in your individual accounts. And so I would just note the vast majority of those using the balanced funds do use our moderate balanced fund. And you can see for the quarter, Q2, up over 14% for the quarter, beating the benchmark by some 40 basis points and beating the Lipper target fairly significantly, a couple hundred basis points there over performance. So kudos to Dave, Lon, Minotti, and that team for managing what was an exceptionally a volatile quarter, but doing so in a way both for the short term and the longer term for our clients. Let's take just a couple of quick slides here before we turn it over to another poll and then talk a little bit about our responsible investing climate over the first half of 2020. Interesting slide here. You can see sort of the whiplash on the far right. Markets hit what was a high on February 19th, 2020, and then precipitously fell and then pulled straight back up in Q2. This was, of course, led, as we note in the bullet, by the significant monetary and fiscal stimulus, some 2.4 trillion, about 12% of our GDP, gross domestic product. Significant and swift action at the end of Q1 and into Q2 from the federal government enabled markets to steady themselves and then rebound exceptionally nicely. Of course, markets are one thing and economies are the other. So the next two slides take a look at some economic data for various industries. And you can see there at the top left, total retail and food service sales dropping precipitously in March and April, and then with a strong rebound in May. In the two bottom slides, also interesting to note, pending home sales and mortgage applications for home purchases, both frankly, not only just rebounding, but moving up. Pending home sales is interesting given the fact that we're still, as a reminder, in a 10% unemployment range. And so the pending home sales and the mortgage applications bodes well, hopefully, for a rebounding economy as well. On the service side and the manufacturing side, you can see the ISM Manufacturing Survey Index at the top right. Any numbers below 50 typically are mean contraction, while above 50 for that index is growth. And you can see that in June of 2020, our manufacturing survey index pulled above the 50 mark. And you can see there also the consumer confidence numbers getting slightly better coming out of May. But the unemployment rate, again, as we are reminded of in that bottom right-hand slide, still in the neighborhood of 10 to 11%. And as we'll note, of course, this week, for those receiving unemployment and some additional benefits due to the COVID crisis, the additional benefits in tomorrow, this week actually, and remains to be seen how Congress is going to act on a go-forward basis. On slide 17, you'll find a historical context for where we are as it relates to our current recession. So if you go to the left, it goes all the way to 1910. And then up and down on the y-axis, you'll see the length of the recession in years. Anecdotally, I had an interesting conversation with my grandfather, who is 95 years old and still works full-time on our family's farm in Southern Illinois about a month or two ago. And as we were talking about the economy and how it's going to impact farming, he mentioned to me, sort of offhanded in a way, although in a serious tone, that he certainly hopes that this doesn't turn into another Great Depression. This is said by somebody who lived through it. And so while many of us in my generation and younger and older obviously did not live through that, you can see the scope of the Great Depression on the left, 3.5 to 4 years long, basically a 26 or 7% decline in real GDP. Since then, we've seen a number of recessionary periods, and at the current moment, our 13% or so decline in real GDP is fairly significant historically. But this slide puts into context what other recessionary times have been like and how long they've lasted. And you can see there that since the mid 1930s, we've had several recessionary cycles, all of which have lasted somewhere between 6 and 18 months. And then we're followed by, us being able to pull out of that recession and our economy move forward. We're hearing as we move into earnings seasons after each quarter, many companies, for example, 3M this morning, pushed aside all of their earnings estimates until 2021. We're seeing a lot of that from companies and economists. Everyone is pushing out their earnings estimates until perhaps a post-COVID world. The slide on the left is interesting. As of 12/31/2019, you'll note the darker bar are the earnings growth estimates by industry. You can see there utilities and technology on the left. The earnings estimates were positive as of 12/31, and then as of 6/30, still positive. But for the vast majority of industries, including some significant impact to energy, consumer discretionary, financials, and industrials, the earnings growth estimates have contracted significantly just over the course of a 6-month period. And so investors have to take a wait and see approach as it relates to earnings. And it really lends itself to experienced active managers who are able to not only select the correct securities, but also overweight and underweight industries and regions of the world that we think could be positive for the portfolio on a go-forward basis. And the next slide speaks to that. For our investors in our balanced funds, and for those of you using the total equity fund, the equity portion of the balanced funds and the total equity fund are benchmarked to the MSCI All Country World Index, which you'll see at the right top. And then you can also see where technology and cyclical sectors play a role in U.S. economies, as well as those outside the U.S. in Asia, Europe, Japan, and emerging markets. And what we would tell you generally is that just like our total equity fund is globally diversified and benefits from that approach, we think that a globally diversified portfolio over the course of the next year or 2 or 3 could pay dividends, particularly in an active management scenario where you have professionals that have seen some of these things before and are able to proactively position the portfolio to take advantage of when we have a return, for example, in Europe to cyclical sector outperformance as they get past the virus quicker than we do here in the U.S. As we know, technology has propped up much of the market returns over the course of Q2, but that won't always remain the case. And so we have to be active and vigilant on your behalf as your trusted investment partner. So finally, just to wrap up, Q2 really benefited from our active management of the portfolio over the course of the first half of the year. Again, 6 of 7 managed funds exceeding the unmanaged benchmark, 5 of the 7 managed funds doing the same year-to-date 2020. We are, of course, remaining vigilant and understand that the COVID-19 crisis continues to impact our economy, and we are keeping a close and watchful eye over the portfolio. We understand that while markets have become in some ways decoupled from the economy, we have an obligation to manage both what is there for us over the short term with an eye towards the long term on behalf of our clients. And then, of course, over the course of the next 6 months, a lot will change in the U.S. Undoubtedly, a presidential election and trade talks being at the height of those. And so I appreciate you listening along. Hope you found these last few slides helpful. Before I introduce our next speaker, I am going to share our next poll. So I would ask that as I make this live, again, as you did so admirably before, we have a one-question poll for this one, and it is multiple choice. So I'm going to launch that. And as I do, I want to introduce our next speaker. I've had the opportunity to work with Stacy Pettis for the better part of the last 5 years, and Stacy is our executive of institutional relationships. She does an admirable job in service to our clients nationwide, but especially those clients that are located up and down the East Coast. Stacy came to us with a tremendous amount of experience from Fidelity and Goldman Sachs, and she'll be speaking with you today about some of our positive news around responsible investing. Stacy?
Thank you, Matt. Thank you for that awesome introduction, and welcome again to everyone. Thank you for being here with us. I have the pleasure of sharing with you some of our social responsibility platform, how we have been working on behalf of all of you, and some of the things that we're looking to do as we step into the future as it relates to responsible investing. So in this slide, we just wanted to highlight first what responsible investing means to us at UCF. So this is a term that is used quite frequently, but has a lot of different definitions. And so the way we interpret responsible investing is not only avoiding certain companies that may be morally out of alignment with our beliefs, but we also look at sustainability and human rights and community, businesses and environmental risk. We also look at environmental, social, and governance investing, which Charles talked about at the beginning of the presentation. And then we also look at impact investing. What kinds of investments can we make that really create positive outcome and outlook for the world, the greater world, as we look to be in contribution. So Matt, if you click over to the next slide, we just wanted to share with you our exclusionary screens. This is something that we have shared in the past, and we made some adjustments to our screens in 2017, I believe, to really take a more justice temperament to how we evaluate companies that we invest in. So we look to avoid securities of companies that derive a significant portion of revenues from some of the industries over to the right. And then we also look to avoid investments in companies whose practices within the following ESG impacts are unacceptable. And so you can also see those listed to the right. And in moving forward, I wanted to highlight what we think about and what we do as it relates to corporate engagement. So screening is definitely a process of how we look at responsible investing, where we choose to divest from certain companies, but then we also really look to engage with corporations that we are shareholders of, and sometimes with corporations that we don't currently hold positions in. And we do this so that we are able to create an educational opportunity and also create impact and change as it relates to companies on a policy level. And so we do that through both shareholder resolutions and corporate dialogues. Shareholder resolutions tend to be a more formal process where we have an item on a corporation's agenda at their annual meeting and we bring forth our concerns. And then corporate dialogues tend to be more informal conversations to highlight some of our concerns. And so we use both of these within our responsible investing strategy. And I'm going to highlight two examples of some of the corporate engagements that we have been involved in over the past couple of years. And so one of them that I'm highlighting is is how we help to support the Standing Rock Sioux tribe. So in North Dakota, this tribe was seeking fundamental justice in keeping the Dakota Access Pipeline from being constructed across drinking water resources, sacred sites, and burial grounds. And so the church responded, the national setting of the church responded in a number of ways when there was a call for faith communities to get involved. So the South Dakota Conference was very involved, as well as the Justice and Witness Ministries on the front lines of protests. We, as an investment institution, we were called to examine our investments and see how we could prompt change from the angle in which we work. And so, although we were not shareholders of the umbrella corporation that developed the pipeline, we did own shares of Marathon Petroleum that was involved with the pipeline developer. And so that provided an opportunity for us to have an opportunity to engage on a corporate engagement level. And so we welcomed the chairman of the Sioux Tribe, Dave Archambault, to our UCF offices, along with some other investors and ecumenical partners, to get a greater understanding of what has been taking place and the impact of this pipeline on this tribe and on this region. So that was very helpful. We also offered our seat at the Marathon Petroleum annual meeting to give a member of the tribe an opportunity to speak directly to the company management to voice their concerns. And ultimately, we co-filed a resolution, a shareholder resolution, alongside many investors, urging Marathon to disclose its due diligence process on environmental and human rights risks. And this also included Indigenous rights risks. The resolution was highly received and got the support of 35% of the investors that voted. And ultimately, Marathon ended up adjusting its policy to include responsibility around human rights. So that's one example. And I also wanted to shift to some of the work that we have done as it relates to private prisons. So we do currently have a private prison screen where we do not invest in any company, in any private prison companies. But in 2019, we wanted to look beyond just the private prisons owners to actually look at the companies that were financing private prisons. And so UCF was part of a group of investors acting against illegal detention of refugees, which was very prevalent in private prison facilities. So we decided as an organization to file a shareholder resolution with SunTrust Bank. This is how we started this effort we asked them to develop a board committee to oversee human rights risk, and they did. We also conducted several conversations with them, which provided an opportunity to articulate why investing and financing of private prisons could leave them open to human rights risk. After successful negotiations and some help from some of our board of directors that have connections with the bank, SunTrust ultimately announced that it would no longer fund private prisons. And in the following months, Bank of America followed suit, as well as JP Morgan, and we've seen additional banks also make that same commitment. So Matt, if you would flip over to the next slide. I just wanted to highlight that as a staff, along with our board of directors, we are very present to the racial injustices that have existed in our nation as it relates to Black and Brown Americans. And we know that the UCC national setting and all of you have been at the forefront of racial justice, calling for everyone to do their part. And so This looks very different for all of us, but the national setting has highlighted that we should be disruptors of institutions with unjust policies and practices, and look to dismantle systemic, institutional, and individual racism. And this is ultimately what's going to build a stronger faith-based movement for peace, justice, equality, and inclusivity. And our board of directors has been so committed to addressing racial equality within the work that we do as it relates to our investment manager selection and portfolio construction processes. And they are committed to evaluating ways that we can be more inclusive in sourcing and discovery of investment partners that we work with, so that they reflect, capture, and value our diversity. And I highlighted one of the quotes from our investment committee chair, Lisa Hines, who has been playing a significant role in starting this process and moving us forward. So in flipping over to the next slide, I wanted to highlight that UCF has always had an investment policy statement and investment policy guidelines in which we use to make the investment decisions on behalf of you all. And part of those guidelines include a proxy voting guideline. And the proxy process involves voting ballots of holdings based on UCF voting guidelines. And so the purpose of the guidelines encourage and support corporate policies and actions that promote human health, dignity, environmental integrity, and moral responsibility. And then I wanted to highlight that we specifically have in our proxy voting guidelines that we support boards that are composed of qualified individuals who reflect a diversity of experiences, gender, race, and age. And then we also support proposals that seek board inclusivity. So in flipping to the next slide, in the past few weeks, actually maybe a month or two ago, we actually became a signatory of the Investor Statement of Solidarity to address systemic racism. And I listed here what that includes. And so some of that is an acknowledgement of what exists currently in our nation. And then second, our 5 calls to action that really help to create change. And so we have signed on to this as a signatory, as part of our commitment with the Interfaith Center of Corporate Responsibility, as well as other faith-based investors, to really commit to amplifying Black voices, to ensuring that we take a justice lens and racial equity lens in the work that we do in our organization, evaluating our staff and our board of directors and the composition that is currently present, and ensuring that we continue to advance anti-racist public policy. And so in the next slide, I highlighted some of the diversity that we have within our board of directors, which is on the top line, where you can see the race and ethnicity diversity as well as our gender diversity. And on the second is our investment committee. Not all of the members of our investment committee are members of our board of directors, so we outline that separately, so that you can see kind of what the makeup is of our board of directors and investment committee. And then on the next slide, I wanted to highlight our staff diversity as well. So these are the people that most of you are talking to and working with every day through email or phone calls and video conferences now. And we're a really dynamic group of staff, and so we wanted to just share the work that we're doing. And I hope that this was insightful for some of you and educational, and I want to thank you for your commitment to being invested with United Church Funds and allowing us to do this kind of work on behalf of all of you. Matt, I'll turn it back over to you.
Stacey, thank you and well done. Certainly appreciate all the work that you put into those slides, and certainly hope it's clear to all that participate that we deeply as an organization care about racial and gender equity and are working towards that within the portfolio on your behalf to make sure that the funds that you've invested with us not only maximize return, but also maximize your voice in that fight. And we certainly appreciate the opportunity to serve you. So with that, we're going to turn to some of your questions. I certainly appreciate that. I certainly appreciate all the questions. There have been a handful, and so I really appreciate it as we go through them. The first question that I'm going to get to was from Ann McCorkindale related to our fixed income strategy. Our existing core fixed income team, as you may remember from past town halls or from past meetings, is part of the pension boards of the United Church of Christ. They have done an admirable job for us, significant actual outperformance over the last 6 months. Prior to that outperformance, however, our board and investment team had considered the opportunity to diversify our fixed income fund. As I mentioned before, most of our equity funds have 2 and most have 3 different managers. And so the fixed income fund really relied on one large core fixed income manager. And so in the interest of diversification, our investment committee, in consultation with our investment team and our investment consultant, Goldman Sachs Asset Management, went on a search and found that we were able to partner with Nuveen, exceptionally large and well-known fixed income manager, through what is called their Social Choice Fund. This strategy has been in place a long time through TIAA-CREF and has quite a good track record. And so of the 200 million or so fixed income dollars that we have invested, not within the Beyond Fossil Fuels program, we have invested actually over the course of the last couple of weeks, $100 million with Nuveen to be able to diversify our fixed income approach. And of course, with the hope of generating better returns over time. We will be able to speak more about Nuveen probably on the Q3 call. As I mentioned, we just made that, I should say the investment team just put those assets to work at Nuveen over the last couple of weeks. And so hopefully a good story to tell over time. We had a question on the total equity fund performance versus the S&P 500 from Bing Heckman out in Palo Alto. Bing, hope you're well. Our total equity fund, remember, is a global equity fund. And so over the shorter term, again, over Q2, and we think probably moving into Q3, the relative overweight of technology in the US economy versus other economies will probably spur US growth over the shorter term. But we do think that as the virus hopefully goes away over time, those cyclical sectors will make a comeback, and the cyclical sectors are what drive international markets typically. And so we think that our global approach over the course of time will be beneficial. Remains to be seen, but you can take a look at the total equity fund over the quarter versus the domestic core equity fund to give you an idea of where that performance was there. And happy to answer any additional questions about that offline. Bill Taylor had a question about, and I think this was in the context of our screens, as it related to the term of sort of significant revenue versus just any revenue from a particular activity or industry. Your point is well taken. We have traditionally, United Church Funds, had revenue thresholds that when we take a look at a particular company or industry, particular company in an industry, if they derive, say, 5 or 10% of their overall revenue from one of those screened industries, we will not invest. So the revenues thresholds are themselves are significant. So we feel like we're getting the most there that we possibly can. And then we had a question from Val Vogel. I'm sure there's others, by the way. These are just the ones that I had jotted down. The impact of current monetary policy inflating equity markets. I would say that Yes, absolutely. The current monetary policy is propping up, particularly U.S. equity markets. And how long that continues remains to be seen, although I think the Federal Reserve has been, in their leadership, has been fairly clear that they will basically do whatever is needed to be able to support the economy and make sure that our economy gets through this COVID crisis and hopefully towards a healthier future. Just looking through the Q&A here. Valerie Neville has a question. What percentage of socially responsible investing strategy is international versus domestic? Our socially responsible investment strategy runs across all of our funds, both equity, internationally or domestic, as well as fixed income, with the exception of our alternatives fund, which has some of those alternative asset classes. But for the vast majority of our investors, the socially responsible investing strategy is comprehensive across all of the funds. And Stephen Hotchkiss has a question. Do you still have confidence in emerging markets, or are you specifically looking at China and India? Good question, Stephen, appreciate that. We actually, as Dave Clausen and his team would tell you, we actually took some gains out of emerging markets at the end of Q2. And those went to cash and I believe a little bit, mostly to cash, a little bit to US equity. So I would say that our confidence in emerging markets is still there over the long term. We think that there is a real case to be made as the middle class emerges in many of these economies, that over the longer term, we definitely need to have emerging markets in our portfolio. But we do at United Church Funds, again, have that sort of flexibility to be able to underweight or overweight various asset classes. And emerging markets is one right now where I believe we're fairly neutral to the benchmark after being actually slightly overweight to emerging markets for the better part of the last year or so. As it relates to questions in the chat, just going through a few of those, I'm just going to take a couple of more questions in the interest of time and then wrap it up.
I think you have covered most of the questions in the chat.
Great. Excellent. Okay, fantastic. Just making sure we got as many as we could on board there. So I will wrap up this call by thanking, first of all, my colleagues at United Church Funds, Charles Buck, our CEO, Stacy, for her admirable work, not only today, but every day, and to Adam and Debbie, our communication staff, who do an excellent job. For those of you who have had the pleasure, I guess, or misfortune of having to sit through portfolio reviews with Stacy and I, going through those presentations would not occur without Debbie and Adam's support, and all the emails that you receive from United Church Funds. All of those communications begin and end with them, and they do a fantastic job. I also want to highlight our back office accounting team. They do a tremendous job behind the scenes, making sure that our organization is run efficiently and effectively. We just wrapped up our annual audit, and we've had several years of clean audit reports, and we appreciate our accounting staff doing such a great job over time. And also, last but not least, certainly our client services team, who many of you interact with on a weekly or monthly basis. Millie, Krista, Gaylord, they do a fantastic job, and we want to highlight their work as well. And lastly, and probably most importantly, I want to thank you as our clients. We are greatly appreciative, and we understand our unique responsibility to manage nearly $1 billion on behalf of 1,100 investors all over the country. We take that responsibility seriously, both in generating performance, and our investment team is to be commended for that, and also through our responsible investment practices, hopefully melding our ability to generate growth in the portfolio and the ability for our portfolio to generate justice in this world. So I'm greatly appreciative for everyone participating. We will be following up with you via email. If you have additional questions, please don't hesitate to reach out to us, to Stacy or I, either one individually. Once again, thank you so much for joining us. Have a wonderful evening and rest of the week. Take care.